Hi, I'm Mark Persano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show. A lot of things to talk about, a lot of moving pieces, a lot of new data that's come out. So first we wanted to look at, global manufacturing in segment one, talk about, how services has been resilient, how much longer can that last? Is that something that's going to catch up? And then some other key global data points, because there's a lot of things that are happening around the world when you start looking at underlying growth. Then when we want to look at in the U.S. in segment two is the pace of inflation. It slowed, yes, but it's still rising and it's still going up. And I think that's the problem when you start looking at year over year, month over month. And, we touched on it in the EIA show yesterday, talking about how, some of the bigger jumps are falling off in gasoline and it's no longer going to be deflationary. It's just going to kind of catch up. And you're still seeing that year over year price, and those are some of the key pieces that we want to look at. Then we want to look at how labor remains tight. That savings cushion that we've heard so much about has disappeared. And we'll talk about the pace in which it's gone away. What does that mean for some of the housing market? Then we're going to look at Europe, which is already in recession. Does it get worse? Has it kind of peaked in terms of where it's going to be? Or is there some more downside as the ECB is likely to continue to raise rates? And then we want to look at China's stimulus and how it's failed on multiple fronts, and how the most recent one, or as they call it, the fourth arrow, continues to fall short in terms of delivering some of these opportunities. So one of the things that we want to look at is, is the world economy already in a recession? And you could say pretty comfortably the answer is really no, not yet. And we looked at two different, Oxford Economics, and then you have one from the National Statistics Office. So the global economy is caught between stagnation and contraction, and that's what we've been talking about. Is that we're just going to kind of flatline, and then start to trend lower, but one of the things, and I think the world economy chart, the one on the left that shows the nowcast at about 1.2%, is showing you it's not going to be this precipitous drop, but kind of this slow bleed down as you get the tightness filtering through, as you get that pains kind of filtering in. And that's really where we're seeing, and that's why when you look at the probability of about 50% reflecting a hard versus soft landing dilemma, normally, once the 50% threshold is crossed, a recession followed. But again, nothing about this cycle is normal. And the reason why so much of this is abnormal is because of the level of stimulus that came in during that 2020, 2021 period, how there was a significant amount of stimulus even before that. And now it's a matter of, okay, well, where's commodities? We're in the 70s situation where commodities are on a supply side or on the shorter end, but demand is falling. So again, there's so many interlocking pieces, which is creating a lot of this kind of strife back and forth. One of the things that we do believe, though, is that the world is continuing to move in a downward trajectory. Manufacturing's already in a recession. If you just look at manufacturing industrial, it's the service side that's holding us up. And that's the difference when you look at the consumer, who was the beneficiary for the most part for this extensive amount of stimulus. They're still out there buying, but when you start looking at credit card rates, interest rates, and just the level of debt that they're sitting on, that's going to go away, and it goes away quickly, but it doesn't happen all at once. Unlike manufacturing, where you're going to get bulk orders, and then those are things that can adjust fairly quickly. Where I think the service side, it really takes that time to catch up. And because, some people are going to spend longer than others, some have more leeway in terms of what their savings can be, on what debt they're willing to take, and that is going to keep this kind of uneven. But realistically, the manufacturing is already giving us the indication of the direction we're going, but it's not like we're just collapsing. Now, the thing that makes it worse is, especially when you start looking at the political polarization, which is high. And for those that have read the articles that we've put out discussing, the polarization, how it's been on an upward trend since the 70s, it's no surprise to see that it continues to grow, because people are frustrated, I think is the best way to say it, with mobility, with their current level in life. When we'll start showing you some of the data when it comes to affordability of homes, you're seeing the people unable to get ahead, and that creates more anger and resentment, and it continues to grow and fester until eventually, it erupts into something like we've seen in France. And it can be something innocuous. It doesn't have to be this massive reason of, it could be something where you're like, oh, well, that's a small event, but then it compounds, it snowballs. And it's because the tension is already built up so much. And it's fascinating because a lot of this is being blamed on rising rates. All these rates are creating all these problems. But then you look at global monetary conditions, they're still not restrictive. And it's because we're so drunk on this cheap policy. And when you look at the real policy rates, which I think is fascinating, going back to 2006, 2007, we've been negative. And then we were exceptionally negative as we got into 2020 and 2021. And now we're in the process of unwinding a very easy policy of the last, 2 decades. But then when you go back to from 1980 to about 2005, real rates were positive. And so, yes, it takes time to come out of this. And that's why the ratios are where they are, why they continue to move. But again, there's going to be a comeuppance. There's going to be that adjustment. And that's why, again, there's nothing showing us that rates have to fall. Everyone else keeps waiting on and hanging on. Well, just tell me when you're going to cut rates. Don't tell me if they're going to keep going up. Just tell me when we're going to cut rates. It's like, well, but there's still a significant amount of easiness in the market that needs to be addressed. Now, when you start looking at global PMI output by sector, manufacturing output, as you can see, is negative, but the service business industry is rolling, but still positive. And again, and that's what we've been talking about is, it's going to come down. It typically follows the path of manufacturing, but it doesn't have to happen all at once, and it can happen in different levels of extremes. So the latest PMI data highlighted that the global economy cooled in June. The headline index fell from an 18-month high of 54.4 to 52.7. The slowdown was due to softer growth in services activity and a fresh contraction in manufacturing output. Now, manufacturing has been bumping along the bottom, and it started to turn and roll a bit more. And we think that roll on the manufacturing side actually accelerates a bit, but not like it's going to go to 45. It's just going to come down to about 48 and really hang around there. And that's going to pull down that service front as you see more and more pressure. And I think the global PMI output expectations are showing that the manufacturing, there's that expectation of what we talked about, of that continuous move down. But the service side, people are still holding in that the service is going to be okay. And that's where we think there's going to be that tweak. But calling that is so difficult because the consumer is fickle. It's hard to nail down the consumer, especially when we're looking at global PMI moves, because every culture, every person is going to have a different appetite for risk and activity. Sentiment across goods producers ran below the long-run average. Service providers remain upbeat as optimism registered a 13-month high, indicating that the divergence between the two sectors looks set to persist in the coming months. So again, it's just going to take time for that data to catch up. Now, when we look at new orders, June PMI data revealed that resilient worldwide economic growth remains driven by the demand resurgence in the services economy, while manufacturers struggle to secure new orders. And that's, again, that leading indicator when we sit here and say, it's manufacturing is going towards that 48 realm. It's just looking at those leading indicators. We're seeing that pressure slowing back down, and the service new business is starting to crack. But again, it's still at just north at 54. It's not like, it's at 51 on its way to 49. And that's where we see some of these fresh points. And it's interesting to look at what is driving that. So when you look at the global PMI sector new orders, financial services, banks have slowed down, insurance is still up there, but real estate hasn't really started to roll. And that's the one that we want to look at the most, especially as we go through the next few months, to see where is global real estate, because that's the thing that has been able to hold in, but it takes time for those rates to really roll down and create that impact. And that's where we see some of the biggest impacts and biggest issues as we go forward over the next few months. So by broad industry, the strongest global growth of demand was recorded for the financial services in June, where the uplift in new orders was the second strongest since October 2021. But we do see a bit of that roll in the coming few months. Sector new orders, consumers. So we look at all sectors: consumer services, consumer goods. So this is, as we were talking about, there's the convergence where consumer goods drop first, but now the consumer services is going to catch up, and one leads the other, and it can vary based on what is happening in the market. Is one deflationary, inflationary? And this is where we see some of those pressure points. So new business inflows received by consumer service providers increased, but global new orders for consumer goods fell for the first time in 5 months. And that's where we're seeing that crack. And that's where we think it accelerates from there and gets to that's pretty, I don't want to say steeply contractionary, because that's not the right way to put it, but more along the lines where it's like we're clearly in contraction. It's not like a 49.5 where it's like, well, depending on how you look at it, it's kind of flattish. It's something where you're seeing those movements down. Now, on the PMI sector, new orders on construction and machinery, basic materials, goods recorded the steepest downturn in demand of all sectors monitored by the PMI, and the decline of a similar size was seen for construction. So again, that's where you're seeing that pretty precipitous drop is happening on the construction side and that activity front. Data split by country highlighted that India continued to lead global growth. However, the slower than anticipated post-COVID-19 recovery across China seems to now be waning, and is growing concern for the global economy. And this is what we've been saying, is that everybody was relying so much on China, where it's like, oh, it was going to be huge activity, revenge spending. And now it's like, well, they're going to need stimulus just to maintain a semblance of growth. And that's where we see some of these underlying issues. As you look at obviously the Eurozone and the Euro in general already in that contractionary standpoint, that's going to continue to result in, again, pulling some of that global growth down. And as we said from the very, very beginning, people are overestimating China, and that continues to flow through the system. Real goods exports as a percent change from September 2022, you could see developed markets, the world in general is negative, again, moving into that contraction. We talked about on the EIA show when we looked at Fujairah and Singapore as some of these key hubs for trade. And it's just, you're not seeing a lot of that pressure, but you're seeing a lot of that pressure in terms of that export market. We'll talk more about it in segment 3. And then when you look at global food price inflation, it's still up. And again, these are things that hurt the most. So when you look at the U.S., I think it's interesting when you look at the percent change since the pandemic. I mean, the U.S. is still at 20%. So everyone's like, oh, look how great inflation is. It's like, it still went up on the month, which means that people are still paying more in July, or for this point, June. They were paying more in June than they were in May. And now if you look at just the inherent math of July with where energy prices have gone, they've gone back up. So realistically, you're going to get, and I don't want to say this huge acceleration, but you're going to get more inflation in July. And remember, we were already supposed to be well past this. And this is why in the next segment, we're going to talk so much about month over month versus year over year. Because yes, is the pace slowing? Absolutely. But it's still going up. And when you're the consumer sitting there spending money day in and day out on just your general living expenses, sure, it's not going up to the same rate, but it's still going up and still impacting me on a real level. So then when we start, putting this all together, the world continues to slide further into recessionary territory with both activity and inflationary pressures falling. June global manufacturing was down 0.7 to 47.7, below that 50 threshold for the 10th consecutive month. Price pressures have moved down, but again, that world real activity is steep, is in that a bigger contraction. Like we said, of that 48, there's no arguing that at this point in time, we are in a recession from the manufacturing standpoint, the industrial standpoint, and that's, again, going to weigh and pull down the service side. Activity components declined for a fourth consecutive month to 47.6, driven by advanced economies. Emerging markets declined less than developed markets, widening the gap further with the developed world. But remember, one leads the other, which is why we've talked about, again, that acceleration to the downside. And remember, this is when we're talking manufacturing, industrial, that's diesel demand, like that's distillate. And that's why when we talk so much about some of those issues and those pressure points on the crude side, this is really what we're looking at when we're talking about some of those pressures. By country, activity components showed 27% of countries stayed in expansion, of which 19% are slowing down and 9% are accelerating. Indonesia the most, and India the best position, 12% are recovering. Vietnam the most, 59% are deteriorating. So again, you're still in a deteriorating setup, and that's why it's important to look at if you're slowing, deteriorating. Well, it's like you're not decelerating. You're actually getting worse. You're going from growth to negative. Decelerating is going from 55 to 53 on a PMI basis. This year, seeing them go from 51 to 48. So, and that's where we see those pressure points rapidly growing. India is starting to decelerate, but still growing. The biggest shift is that China one, which is right dead center between deteriorating and decelerating. And that's where it tips the scale to the left. And because China is the second largest country in the world, that scale tipping to the left is, again, going to pull that and move things lower. Inflation components show that short-term pressures continue to decline rapidly, while well below the long-term average of both advanced and emerging economies. But the key point when you start looking at the inflationary pressures is the situation between sticky versus flexible. So flexible, always looking at goods prices. Obviously, when we talk about energy can be that flexible movement of, it could be inflationary in July, deflationary in August, and that can move. But the sticky side is the service front, and the fact that services continues to be at the levels it's at is again helping to keep that inflationary pressure elevated and stronger than I think many in central banks would actually like. Global food per capita supply, it didn't fall in 2022, but one of the things that we've been talking about, and we said we saw it starting back in that 2012, 2013 level, is that you were starting to see this rollover in yield, and you were starting to see this deceleration. And it was one of the things that we said, it was going to flatline and then start to roll over as the world population continued to grow. And we're starting to see that now play out, given these are trying to use U.S. Department of Agriculture numbers, and there's always going to be some fungibility in it. Like we would say, we're already in decline when you look at metric tons. This is showing that we're still growing slightly, but rolling. Our view is that this is being a bit convoluted from 2020, but realistically, 2020, 21 was really the peak, and now we're seeing that deceleration to the downside, especially as weather patterns shift, and we continue to see those impacts. Now, when you start looking at central banks that are looking at what is inflation doing, how are people's living standards, the developed market versus emerging markets are moving closer and closer to rate cuts versus rate. And that's possible, but the problem is that stickiness around the inflation side, where they may talk about it, but like if you look at India, you just had a reacceleration in some of the inflationary pieces. You get these months where everyone gets really excited. It's like, oh, here it is, like the deceleration's here, rate cuts are coming, and then the next month you're like, oh, that accelerated again, and we're in this kind of back and forth where we're not getting a clear indicator that it's safe to start cutting rates, and that's something that I think is going to hinder some of that activity going forward. And then when you look at the zombie companies, viewing countries by proportion of zombies relative to listed equities, Norway has the highest zombie prominence within its markets, and it just means that companies that aren't generating revenue, just things that need cheap debt, need these cheap rates. And it's interesting to look at the proportion of it: Norway, China, South Korea, Taiwan. A lot of this is on the tech side, and this is why we think that the market is at its almost peak frothiness. When you look at this massive reacceleration, it's like, well, some of this isn't real, and that's what I think rates being where they are longer is really going to help flush that out. Then when you look at JP Morgan Global Composite Output Index, looking at the composite of it, global private sector growth cooled in June at a 4-month low of 52.7. The slowdown resulted from a softer expansion activity at service providers and a contraction in manufacturing. So again, that pull down, that slowdown is really there. And then when you look at the U.S., inflation fuel spending on Independence Day cookouts, total estimate spending in the United States on Independence Day food items went from $6.3 billion in 2014 to $9.5 billion, just to kind of give you an idea of the pain on that. And then it was interesting because the leading and coincident economic indicators, when you look at some of the leading sides, continue to show some of those slowdowns and where a lot of this pressure is going to continue to hit. So that's what we have for you on the global front. And now in the next segment, we're going to go deeper into the U.S. and some of the important caveats on the inflation numbers and what we think that means for what the Fed action is going to be over the next few months.